Hey, good afternoon, you guys. Good evening. Boris Portnov, Bergen County Realtor, short sale, foreclosure, loan modification specialist. We work with distressed homeowners. We assist them. Ways in which we assist distressed homeowners is loan modifications and short sales. I'm going to just quickly go over. Today's topic is not about loan mods or short sales, but I'm just going to quickly review it so everybody's on a level playing field in terms of background knowledge. What's the loan modification? A loan modification is when you have a hardship which has resulted in a decrease in income. So you reach out to your lender and you make them aware that your payment is no longer affordable due to a decrease in income. You need to document your hardship with financials. Your lender is going to review those financials. They want to ensure that your payment is no longer affordable. Affordability is defined as roughly 31% of your gross income. Your mortgage, taxes, insurance should not exceed 31% of your net, your gross income. If your payment exceeds 31% of your gross income, your lender can review certain tactics to try to get your payment down to an affordable number. They can lower they do what we call a waterfall, in which they try various tactics in a waterfall cascading method. Number one, they'll try to decrease your interest rate to as low as 2%. Number two is they will then forbear a portion of your amount, a portion of the amount for which you're in arrears, and the back end of your mortgage is a balloon payment. And number three is they can re-amortize your mortgage up to a 40-year term. Those are the three tactics in which they can deploy. They'll try number one. If number one alone does not get you down to 31% of your gross, then they'll try tactic number two. If number two, then they'll cascade down to number three. They could try 1, 2, and all three methods simultaneously to get you down to 31% of your gross. If it gets you down to 31% of gross, great, you qualify for a loan modification. They'll put you on a 3-month trial. If that trial works out, then they'll offer you a permanent modification. If you default within 3 months, or if attempting all three does not get you down to 31% of your gross, then you won't qualify. If you default on the 3-month trial, then you also won't qualify for a permanent modification. So in a nutshell, that's what a modification is. Alternatively, we can short sell your home. When we short sell your home, you do not have ample equity in your home in order to repay all your creditors, all the lien holders on your home, on the title. At that point, we reach out to all the lien holders and we negotiate settlements from the proceeds of the sale of the home. We convince your lien holders to take pennies on the dollar in order to settle the liens on your home, because the alternative is that their liens will be discharged in a foreclosure action. If your first position lien holder forecloses on you, all subsequent junior lien holders behind this first position lien holder is discharged in foreclosure, and they'll get nothing. So taking a settlement is definitely a more appealing option than getting nothing in a foreclosure action. So oftentimes they'll agree to take pennies on the dollar to settle the accounts in a short sale. Your realtor will negotiate with all your lien holders on your behalf. It's imperative you work with a realtor that understands this process and has done this many times over again, who successfully negotiated short sales. Okay, so today's topic is about RESPA. RESPA and TILA. TILA is the Truth in Lending Act, and RESPA is the Real Estate Settlement and Procedures Act. Now, what this is certain disclosures at closing, at a real estate closing, certain disclosures your lenders must provide to you. We all understand that when we sign the contract our lender gives to us, it's non-negotiable. The lender says to you, if you want our money, accept our terms. Take it or leave it. You want our money, accept our terms. There's no negotiating of the contract. However, the federal government has put certain disclosures in place that the lenders must abide by in order to increase the transparency of the game, of the lending field. We all understand that we're at a disadvantage. The lenders have all the laws in their favor. However, there are certain disclosures are put into place. So part of RESPA is one of the regulations within RESPA is the qualified written request, and this is when you have an opportunity to request any kind of any kind of disclosure from your servicer of your mortgage. Now, just to clarify, your servicer does not own your mortgage. They may own your mortgage, but not necessarily. They simply handle the customer service aspect of the mortgage. They collect your payments. They respond to all inquiries. If there's late fees, they assess your late fees. They hold your escrows, and they'll pay from your escrows your property taxes and your insurance. In the foreclosure action, they will handle the foreclosure action. They'll hire a lawyer. They'll communicate. They'll deal with the loss mitigation. That's a servicer. So if you have any sort of inquiry, you send it. The QWR is a qualified written request. Goes to your servicer. It does not go to the owner of your mortgage. You can request certain things from your servicer. For instance, if you're falling behind on your payments and there's this whole bunch of late fees being assessed, or if you want an inquiry in terms of your escrows, what's going on with your escrows? You think your escrow funds are being mishandled. Let's say you're in foreclosure, now they're assessing lawyers, attorneys' fees on top of the mortgage amount that's in arrears. These are all accountings that you can request for in a QWR. If you wish to find out who is the holder of your mortgage, who owns the mortgage note, who is the investor, that kind of inquiry can be sent to your servicer in a QWR. Now, there's certain time frames in which your servicer has to respond to your QWR. Within 5 business days of having received your QWR, and by the way, your QWR should always be sent certified mail. Within 5 days of receipt of your QWR, your mortgage servicer must respond acknowledging receipt. Within 20 days after receipt, they must respond sufficiently to your QWR. If they require additional time, within 20 days they need to respond to you and advising you they require additional time, and then periodically they need to update you that they are still working on responding to your QWR. Okay? If they don't respond to your QWR, they're obligated to pay statutory damages. You can sue them for damages, and statutory damages of $1,000 per incident. So this kind of levels the playing field. Now, in the event of a foreclosure action, will a QWR stop a foreclosure? No, it can't. It will not. They are allowed to initiate a foreclosure action whether QWR is pending or not. It cannot stop a foreclosure action. But how is a QWR helpful? A QWR is helpful because if you wish to negotiate a loan modification, now you're coming from a position of strength. You're making the lender aware that you're knowledgeable of all your rights you have to your disposal, and you're not going to roll over and die. A QWR will enable you to negotiate for a stronger loan modification, more favorable terms on your behalf. Now, I'm not an attorney. I'm just a realtor, and I can't write a QWR on your behalf. But there are a lot of templates online available to your disposal, and I need to put it out there. Past results do not guarantee future results. However, QWR, in my experience, has increased the availability for you to attain a better, more favorable loan mod. Thanks for listening, you guys. Have a good evening.